The headline tomorrow morning will be loud. The television anchors will tell you whether inflation came in higher or lower. The markets will surge or stumble within seconds. Social media will explode with confident opinions before most people have even read the report. And millions of investors will believe they already know what happened. But they won't. Because if you own gold or silver, the number that matters is almost never the headline everyone is talking about. The real story is buried deeper. And that hidden story may tell you far more about where your wealth is heading over the next several months than the headline flashing across every financial news network. Ladies and gentlemen, this is one of those moments. Tomorrow, the United States government releases the Personal Consumption Expenditures Price Index, the PCE Report. It doesn't sound dramatic. It doesn't have the excitement of a Federal Reserve meeting or the shock of a jobs report. In fact, many people skip over it entirely. That could be one of the biggest mistakes an investor makes all year, because while the public watches the headlines, the Federal Reserve is studying the details. While television debates the first number they see, professional investors are asking a completely different question. And while short-term traders chase every price swing, the world's largest institutions are quietly trying to answer one thing. Has inflation truly been defeated, or is it preparing to surprise everyone again? That is the question hiding inside tomorrow's report. And if you stay with me until the end, I'll show you why this single release could shape the next chapter for gold, silver, interest rates, and perhaps even your savings. Because this isn't just another economic report, it's a window into the thinking of the Federal Reserve itself. Now let me explain why. When most people hear the word inflation, they immediately think about prices going up. They notice groceries costing more than last year. They see higher insurance bills, more expensive restaurant meals, rising rents, and vacations that somehow cost twice what they expected. That is inflation as ordinary families experience it. But the Federal Reserve cannot make policy based on feelings alone. It needs a consistent way to measure whether inflation is actually cooling, staying stubborn, or beginning to accelerate again. And among all the different inflation reports available, there is one that policymakers repeatedly return to, the PCE report. Not because it is perfect, but because they believe it gives them one of the broadest pictures of how prices are changing throughout the economy. That alone should make every gold and silver investor pay attention. Think about it this way. Imagine you're driving through dense fog. You can't see the road far ahead. The only thing guiding you is your dashboard. If one gauge suddenly begins moving in the wrong direction, you don't ignore it because it isn't exciting. You pay attention because it tells you where you're heading. The Federal Reserve treats the PCE report much the same way. It is one of the gauges on its dashboard, and when that gauge changes, expectations about future interest rates often change with it. Now here's where most investors make a critical mistake. They believe tomorrow's headline will tell them everything they need to know. Inflation rises, inflation falls. Simple, easy, comforting. But markets rarely work that way. Financial markets don't simply react to what happened today. They react to what today's information suggests about tomorrow. That difference is enormous. Because gold and silver don't move simply because inflation exists. They move because investors begin changing their expectations about future monetary policy. That is why two inflation reports showing almost the same numbers can produce completely different market reactions. One changes expectations, the other confirms what everyone already believed. Professional investors understand this. They aren't asking what was the headline. They're asking, what does this change? That single question separates reaction from understanding, and understanding is often far more valuable than speed. Consider what happens inside the bond market. If investors suddenly believe inflation is proving stubborn, they begin expecting the Federal Reserve to keep interest rates higher for longer. Bond yields can rise, the US dollar may strengthen, financial conditions become tighter. That creates pressure on assets like gold and silver because these metals don't generate interest income. On the other hand, if tomorrow's report suggests inflation is cooling more quickly than expected, those same expectations can reverse almost immediately. Bond yields may ease, markets begin pricing fewer future rate increases. Pressure on precious metals can lessen. Notice something important. And in both situations, gold isn't reacting to the inflation number itself. It's reacting to what investors think the Federal Reserve might do next. That distinction is one of the most misunderstood ideas in all of investing. And once you understand it, headlines become much less intimidating. Now, some people hear this and immediately think, so tomorrow decides everything. No, history teaches us something very different. One report almost never changes the entire story. Markets are built on trends, patterns, momentum. The Federal Reserve knows this. Large institutions know this. And experienced investors know this. Tomorrow's report is important not because it answers every question. It's important because it becomes another piece of a much larger puzzle. Think of a detective solving a complicated case. One fingerprint rarely closes the investigation. One witness doesn't explain everything. One photograph tells only part of the story. But every new clue makes the overall picture clearer. The PCE report is one of those clues, not the whole story, just one of the most influential pieces. Now let's bring this back to gold and silver. Many people buy precious metals believing they only rise during inflation. Reality is far more complicated. Sometimes gold rises while inflation is falling. Sometimes it struggles even while prices remain elevated. Why? Because gold is constantly balancing several powerful forces at once. Inflation, interest rates, real yields, currency strength, economic uncertainty, central bank demand, global confidence, government debt. All of these forces pull on the price simultaneously. That is why experienced investors rarely focus on just one headline. They ask a broader question: which force is becoming stronger? And tomorrow's report helps answer exactly that. If inflation refuses to cool, the Federal Reserve may feel greater pressure to remain restrictive. If inflation continues easing, policymakers may gain confidence that current policies are working. Either way, expectations begin shifting, and expectations often move markets long before official policy changes. This is why some of the biggest price movements happen before a single interest rate decision is announced. Markets are always trying to look ahead, always trying to price tomorrow before tomorrow arrives. That is why owning gold or silver requires patience, because if you react emotionally to every headline, you're constantly responding to yesterday's news, while the market is already thinking about next month. The investors who protect their wealth over decades are rarely the fastest. They are usually the calmest. They understand the difference between noise and signal. Tomorrow morning, millions of people will see one inflation headline. Television will argue about whether it was good or bad. Markets will swing. Commentators will declare winners and losers before the opening bell is barely settled. But beneath all that noise, something much more important will be happening. Professional investors will already be asking what this report means for the Federal Reserve's next move, for bond markets, for the US dollar, and ultimately for gold and silver. Because the headline is only the beginning. The real story starts underneath it. And once we understand how those deeper forces connect, the entire picture changes. That deeper story is where we're going next. Now, let's go one layer deeper, because once you understand how the Federal Reserve actually thinks, you'll stop reacting to headlines the way most investors do. You see, the Federal Reserve isn't trying to predict what inflation was last month. It's trying to predict where inflation will be 6 months from now. That is an enormous difference. Imagine driving down a highway. You don't steer by staring directly beneath your front bumper. You look hundreds of feet ahead because that's where you're going. The Federal Reserve does exactly the same thing. Every interest rate decision is based less on today's economy and more on where policymakers believe the economy is headed. That is why tomorrow's PCE report matters so much. It doesn't simply describe yesterday's inflation, it influences expectations about tomorrow's policy. And in financial markets, expectations often become reality long before the official decision arrives. That is one of Wall Street's oldest lessons. Markets are forward-looking machines. They don't wait, they anticipate. By the time the Federal Reserve finally changes interest rates, markets have often spent weeks or even months pricing that possibility into stocks, bonds, currencies, gold, and silver. That is why experienced investors rarely ask, "What did the Fed do?" Instead, they ask, "What will the Fed most likely do next?" Those two questions sound similar. They are not. One looks backward, the other looks forward, and fortunes are usually made or protected by the investors looking forward. Now here's where bond markets enter the story. Most people rarely think about government bonds. They're not exciting, They're not glamorous, but they are one of the most important forces behind the price of gold and silver. Why? Because every investor on Earth is constantly comparing opportunities. Suppose you own a bar of gold. It sits safely in your vault. It earns no interest. Now imagine that government bonds suddenly offer investors a higher return with relatively low risk. Some investors begin asking themselves a simple question: should I continue holding an asset that pays nothing, or move some of my money into something that now pays a higher yield? That comparison happens every single day across pension funds, hedge funds, insurance companies, sovereign wealth funds, and investment managers around the world. When enough investors make that shift, bond prices, bond yields, and precious metals all begin responding together. But there is another layer hiding beneath that story, and this layer is one many investors never hear about: real interest rates. At first, that phrase sounds complicated. It isn't. Think about it this way. Imagine a bank offers you 5% interest on your savings. Sounds attractive. But if inflation is running at 4%, your purchasing power only improves by about 1%. Your money grows, but prices grow almost as fast. Now imagine inflation falls to 2% while the bank still pays 5%. Suddenly, your real return becomes much stronger. That simple relationship quietly influences enormous amounts of money across global financial markets. When real interest rates rise, gold often faces stronger competition. When real interest rates fall, precious metals frequently become more attractive again. That is why tomorrow's inflation report matters beyond the headline itself. Because investors aren't only measuring inflation, they're calculating what inflation means for real returns. And that calculation changes expectations across nearly every major asset class. Now think about the position the Federal Reserve finds itself in today. On one side sits inflation. On the other sits economic growth. Raise rates too aggressively and borrowing becomes expensive. Businesses slow hiring. Consumers reduce spending. Economic activity weakens. But lower rates too quickly and inflation may return stronger than before. Prices begin climbing again, confidence falls, the credibility of the Federal Reserve suffers. It is a balancing act unlike almost any other. Every meeting becomes a question of risk. Which mistake would be more damaging? Doing too much or doing too little? Tomorrow's PCE report helps answer that question. Not perfectly, but enough to influence expectations. And expectations are where markets live. Now, let me show you something fascinating. Many people imagine that the largest financial institutions wait patiently for government reports before making decisions. In reality, they're constantly adjusting their positions long before the reports arrive. Investment firms analyze supply chains, shipping costs, commodity prices, corporate earnings, wage growth, housing data, consumer behavior, manufacturing surveys, energy prices, thousands of individual signals. By the time tomorrow's PCE report is released, many institutions already have educated expectations about what it might reveal. That is why markets sometimes behave in ways that confuse ordinary investors. Imagine the headlines announce inflation has fallen. Most people expect gold to surge immediately. Instead, gold barely moves. Or perhaps it even falls. People scratch their heads. What happened? The answer is surprisingly simple. The market had already expected that result. Professional investors had already positioned themselves days or even weeks earlier. The information was no longer new. Remember this: markets don't reward information, they reward surprises. A report that matches expectations often creates surprisingly little movement. A report that dramatically differs from expectations can move trillions of dollars within hours. That is why experienced investors spend so much time studying expectations instead of headlines, because markets react less to the news itself than to whether the news changes the story. And this brings us back to gold and silver. Suppose tomorrow's PCE report shows inflation cooling slightly. That sounds positive. But what if investors had expected inflation to cool much faster? Suddenly what appears to be good news becomes disappointing. Bond yields could rise, the dollar could strengthen, gold may struggle. Now reverse the situation. Suppose inflation remains slightly higher than economists predicted. At first glance, that sounds negative. But if investors had feared an even worse number, markets may actually rally because reality turned out better than expected. Do you see why headlines alone are dangerous? They rarely tell the whole story. The market is constantly comparing reality against expectations, not reality against yesterday. That single idea explains countless movements that seem mysterious to the average investor. Now let's widen our view one more time. While individual investors debate tomorrow's inflation number, institutional money is quietly evaluating something much larger. Not next week's price, not next month's chart, but the entire direction of monetary policy over the coming year. Because large institutions don't simply buy or sell based on one report, they build probabilities. If inflation continues cooling, perhaps future rate cuts become more likely. If inflation proves stubborn, perhaps restrictive policy lasts longer. Every new report slightly changes those probabilities, little by little, month after month, until eventually the evidence becomes overwhelming. That is when major market trends begin, not because of one headline, but because dozens of signals slowly align into a single, powerful direction. And tomorrow's PCE report may become another important piece of that puzzle. It won't answer every question. It won't determine the future overnight, but it will tell us whether the economic winds are beginning to shift or whether the Federal Reserve's battle against inflation still has much further to go. And once we combine that picture with government debt, central bank gold buying, and the psychology of long-term investors, an even bigger story begins to emerge. Because beneath every inflation report, beneath every Federal Reserve meeting, and beneath every market headline, there is a force that has shaped every financial cycle in modern history, and that force may ultimately matter far more than tomorrow morning's number. Now we arrive at the part of the story that no monthly inflation report can fully explain, because beneath every Federal Reserve meeting, beneath every PCE report, beneath every debate over interest rates, there is a force that moves much more slowly, but often much more powerfully: government debt. It doesn't dominate the headlines every day. It doesn't cause the market to swing in a single afternoon. It grows quietly year after year, almost unnoticed by the average investor. But eventually, every financial system must confront it. Think of a ship crossing the ocean. Small waves rise and fall every few minutes. Some are larger than others. A storm may temporarily push the ship off course. But beneath those waves lies the ocean current itself, steady, persistent, and impossible to ignore. The PCE report is one wave. The Federal Reserve's next decision is another. Government debt is the current. And over long periods of time, the current usually wins. Every time interest rates remain elevated, governments pay more to finance existing debt and issue new debt. Every refinancing becomes more expensive. Every additional percentage point carries billions of dollars in added interest costs. This creates a difficult balancing act. The Federal Reserve wants to keep inflation under control, but keeping rates high indefinitely becomes increasingly expensive for an economy carrying enormous levels of debt. Eventually, policymakers find themselves facing two competing realities: fight inflation aggressively or reduce financial pressure on the broader economy. History shows that this tension never disappears. It simply changes form. That is one reason experienced gold investors rarely build their entire strategy around one inflation report or one Federal Reserve meeting. They pay attention to the bigger cycle, because cycles tend to outlast headlines. Now here's something even more interesting. While television panels debate whether tomorrow's inflation number or 0.1% above or below expectations, many of the world's central banks are doing something remarkably consistent. They continue accumulating gold. Why? Not because they know next month's price, not because they expect a straight line higher, but because central banks think in decades, not days. Imagine managing the reserves of an entire nation. You're not trying to outperform the market this quarter. You're trying to preserve purchasing power through recessions, geopolitical uncertainty, currency shifts, and financial crises. That requires a completely different mindset. Gold becomes less of a trade and more of a strategic reserve. It isn't replacing currencies, it isn't replacing productive businesses, it serves a different purpose. It is one form of diversification against uncertainty. And when many central banks increase their gold reserves over time, they are sending a message, not necessarily about tomorrow's inflation report, but about the importance of maintaining resilient reserve assets in an uncertain world. Now compare that with the behavior of many individual investors. When prices rise sharply, excitement grows. People suddenly become interested. When prices fall, fear replaces curiosity. Many sell precisely when uncertainty feels greatest. That emotional cycle has repeated throughout financial history. The crowd often chases confidence. Patient investors often build positions during uncertainty. That doesn't guarantee success, but it explains why investor psychology matters just as much as economics. History gives us countless examples. During periods of high inflation, markets have experienced dramatic swings. There were months when precious metals surged, months when they corrected sharply, months when investors believed the trend was over, only to watch an entirely different chapter unfold later. The lesson isn't that history repeats perfectly. It doesn't. Every economic cycle is different. Technology changes, global trade changes, politics changes, central banking evolves, but human behavior remains remarkably familiar. Fear, greed, patience, panic, hope. These emotions appear in every generation. Which brings us to the road ahead. No one knows exactly what tomorrow's PCE report will reveal. No one knows exactly what the Federal Reserve will decide at its next meeting. Anyone claiming certainty is offering something the market itself cannot provide. What we can do is think in probabilities. And today, three broad scenarios deserve attention. The first scenario is the hawkish path. Suppose inflation proves more stubborn than expected. The PCE report comes in stronger. Future reports tell a similar story. The Federal Reserve keeps interest rates elevated longer than markets currently expect. Bond yields remain firm. The dollar stays resilient. In that environment, gold and silver could continue facing short-term pressure as investors adjust to the possibility of tighter monetary policy. The second scenario is the gradual cooling path. Inflation continues easing, not dramatically, not overnight, but steadily enough that confidence begins returning. Markets slowly anticipate a less restrictive policy environment. Pressure on precious metals begins easing, volatility remains, but expectations gradually shift towards stability. The third scenario is the one markets often underestimate: unexpected disruption. Perhaps economic growth weakens more sharply than anticipated. Perhaps financial stress emerges somewhere investors aren't watching today. Perhaps geopolitical events suddenly reshape market sentiment. History reminds us that the biggest market moves often begin with events few people predicted months earlier. That is why diversification and discipline matter, not because they eliminate uncertainty, but because they help investors live through it. Now let me leave you with something I believe is far more valuable than any single forecast. Most financial mistakes are not caused by a lack of intelligence. They are caused by emotion. Fear convinces people that today's headline will last forever. Excitement convinces people that today's rally can never end. Reality usually lands somewhere in between. Successful long-term investors learn to separate information from emotion. They don't ignore headlines. They simply refuse to let headlines make every decision for them. Tomorrow morning, you'll hear countless opinions about the PCE report. Some will declare that gold is finished. Others will insist that a massive rally has already begun. Both may sound convincing, but remember what we've discussed. The report is important. The Federal Reserve's interpretation is important. Bond yields matter. Inflation expectations matter. Government debt matters. Central bank behavior matters. Investor psychology matters. No single headline tells the entire story. That is why understanding will always outlast excitement. If you own gold or silver, don't just watch the first number scrolling across your screen. Ask a deeper question. What does this report change? Does it meaningfully alter expectations for monetary policy? Does it change the long-term forces shaping the global economy? Or is it simply another chapter in a much longer story? Those are the questions professional investors ask. And over time, asking better questions often leads to better decisions. So tomorrow morning, stay calm. Read beyond the headline. Watch how bond markets respond. Watch how expectations change. Watch how the Federal Reserve begins interpreting the data over the coming weeks, not just the first few minutes after the release. Because investing is rarely won in the first reaction. It is usually won by the people who remain thoughtful while everyone else becomes emotional. If today's discussion helped you understand why the PCE report matters far beyond tomorrow's headline, I'd genuinely like to hear your perspective. Do you believe inflation is finally coming under control, or do you think the Federal Reserve still has more work to do before declaring victory? And if you own gold or silver, has your investment philosophy changed over the past few years, or has recent uncertainty strengthened your conviction? Share your thoughts in the comments below. Some of the most valuable insights come from investors who have lived through multiple economic cycles and understand that every generation faces its own version of uncertainty. And if you found this analysis helpful, consider subscribing and joining us for the next chapter. Buddy, here is to do to there. Because when the PCE report is released, the headlines will tell you what happened. Our job is to understand what it means. And in the world of wealth preservation, that difference can be more valuable than any prediction.